Before you get approved for a mortgage, I need you to understand something very important. The number a lender approves you for is not automatically the number you should spend. And I know that sounds simple, but this is where a lot of buyers get themselves into trouble, because getting approved answers one question: can this loan technically work? But buying a house should answer a much better question: what position are you going to be in after you buy? Because there is a big difference between being able to qualify for a payment and actually comfortable living with that payment every single month. And in 2026, with the interest rates the way they are, property taxes, insurance, maybe HOA fees, debt, inflation, the cost of everything else, the difference matters more than ever. So in this video, I want to walk you through what nobody really explains before you get approved. Not because getting approved is bad. You absolutely need to get approved before you start seriously shopping, but you need to understand what that approval actually means, what it does not mean, and how you think through the numbers before you make one of the biggest financial decisions of your life. I'm Ivan Cano. I'm a licensed Texas realtor and a mortgage loan originator, and I help buyers look at the real numbers before they buy. Not just the price of the house, not just the approval amount, but the full picture. And if you want me to run your numbers based on your situation, here's the link in the description. As always, no pressure, just clarity. The approval number is not your budget. So let's start here. One of the biggest mistakes buyers make is treating their pre-approval amount like a shopping budget. They get it pre-approved for $350,000, $400,000, $500,000, whatever the number is, and then they immediately start shopping at the top of the range. And I understand why. Because when someone tells you you're approved up to this amount, your brain automatically hears, this is what I can afford. But that is not what it always means. A pre-approval is based on lending guidelines, and it is based on income, debt, credit, assets, estimated taxes, insurance, interest rate, loan program, and other qualifying factors. But those guidelines are not the same thing as your personal comfort level. The lender is not sitting at your kitchen table deciding how much money you want left over after the mortgage. The lender is not deciding whether you still want to travel. The lender is not deciding whether you want to have kids in sports. The lender is not deciding whether you want to help your family. The lender is not deciding whether you want to keep investing, saving, giving, or building a cushion. The lender is looking at the file and asking, does this fit the guidelines? And that is different from asking, does this fit your lifestyle? And that is why I always tell people your approval amount is a ceiling. It's not automatically your target. Just because you can technically buy at the top of your approval does not mean you should. Sometimes it makes sense, sometimes it does not. But you need to make that decision intentionally. Here is the next thing nobody explains clearly enough. The purchase price is not what you live with every month. The payment is. People love to focus on the house price, and they say, I'm looking around $300,000. I don't want to go over $400,000. My max is $500,000, and that is fine as a starting point. But the price of the house does not tell you the whole story. A $350,000 house in one area can have a very different monthly payment than a $350,000 house, somewhere else. Why? Because the payment is made up of more than just the principal and interest. You may have principal and interest, property tax differences, homeowners insurance differences, mortgage insurance, HOA dues, flood insurance in some areas, possibly higher utility costs, and then to top all of that off, your existing monthly debts still matter. That means car payments, credit cards, student loans, personal loans, child support, other obligations. So when you are thinking about affordability, you cannot just ask, what price range am I approved for? You need to ask, what monthly payment actually makes sense for me? That is the real question, because the house price gets your attention, but the payment runs your life. And that is what a lot of buyers get surprised by. They think, well, I found a house in my price range, but then once the taxes, insurance rate, loan structure, mortgage insurance are factored in, the payment is higher than they expected. And then they either stretch themselves too thin, or they get discouraged and think buying is impossible. A lot of the times, the problem is not that buying is impossible. The problem is that nobody slowed down and structured the conversation correctly. When a lender reviews your file, They are looking at what is called your debt to income ratio. That is basically how much of your gross monthly income is going towards your monthly debt obligations, including the projected housing payment. And this is important. Lenders use your gross income, not your take-home pay. So if you make $8,000 a month before taxes, the lender is qualifying you off of that gross number. But you do not live off of your gross income. You live off of what actually hits your bank account. That is why two buyers can have the same income and feel completely different about the same mortgage payment. One buyer may have no car payment, no credit card debt, no kids, strong savings, and a simple monthly budget. Another buyer may have 2 car payments, child care, credit card balances, family obligations, and almost no reserves. On paper, they look similar, but in real life, they are not similar at all. And this is where I think buyers need to be careful, because the lender can tell you what the guidelines allow, but only you can decide what lifestyle you want after closing. Do you want to be house poor? Do you want to be stressed every time the mortgage comes out? Do you want to buy furniture on credit because all your cash went into the house? Do you want to move in and immediately feel like you have no room to breathe? Or do you want a house that fits into your broader financial plan? That is the conversation, and that is why I do not like when buyers ask, how much can I get approved for? The better question is, what payment allows me to buy a house and still live my life? Now let's talk about another thing that surprises buyers, and that is cash to close. A lot of people think that down payment is the only money you need, and so they say, I'm doing 3.5% down, I'm doing 5% down, doing 0% down, I'm using VA, I'm using USDA, and that's all important and well, but your down payment is not always the same thing as your total cash to close. Cash to close can include the down payment, closing costs, prepaid taxes, prepaid insurance, escrow setup, lender fees, title fees, appraisal, and other costs depending on the transaction itself and the way it's structured. So when someone says, I only need 3.5% down, that may be true on a down payment for an FHA loan, but that does not automatically mean that is the only money involved. Now, can seller concessions help? Absolutely. Can builder incentives help? Totally. Can some loan programs reduce the down payment requirements? Yes. Can VA be zero down for eligible buyers? Yes. But zero down does not always mean $0 out of pocket. And I think this is an important distinction, because I want buyers to understand the structure, not just a slogan. A good loan structure can make a huge difference. Seller concessions can help, builder incentives can help, and again, those are interchangeable. Down payment assistance may help in some situations, but you need to know the whole thing fits together and how it fits together. So, because buying a house is not just about qualifying, it's about entering the transaction with your eyes open. And this is why I like to run numbers before someone gets too deep into shopping, because if we understand the payment, the cash to close, and the structure early on, we can avoid surprises later. Again, if you want me to run your numbers based on your situation, there's a link in my description. As always, no pressure, just clarity. Now let me say something that may surprise some people. Putting less money down is not automatically bad. There is a lot of advice online that makes people feel like they need to put 20% down or they're doing something wrong. And that isn't always true. Yes, putting more money down can reduce the loan amount and it can lower the payment. And it may help avoid mortgage insurance depending on the loan program, but it can also make the offer stronger in some situations. But there is another side to that. If putting more money down leaves you with no reserves, no emergency fund, no money for repairs, no money for furniture, no breathing room, then we need to look at that carefully, because the goal is not just to buy the house. The goal is to be in a good position after you buy the house as well. Sometimes putting less down and keeping more liquidity on hand makes total sense. Sometimes putting more down makes sense. Sometimes using concessions to reduce cash to close makes sense, and sometimes using concessions to buy down your rate makes more sense. Sometimes the better move is not obvious until you actually compare the options. That is why I do not like the one size fits all mortgage advice. Always put down 20%. It's too simple. Always put down as little as possible is also too simple. The right answer depends on your income, your debts, your savings, your goals, your risk tolerance, the loan program, the property, the market, etc. And that is why I always come back to structure. The loan structure matters. The payment matters. The cash left over after closing matters. So essentially, the plan matters. Now let's talk about interest rates, because a lot of buyers focus almost entirely on the rate. And I get it. The rate matters. It's what makes the news, right? A 1% difference in interest rate can materially change your payment and your buying power. So I'm not saying that it doesn't matter. It absolutely does, but the rate is only one facet of the whole picture. A lower rate on a bad structure doesn't automatically make it a good deal, just like a slightly higher rate with better overall terms may sometimes make sense depending on the situation. A builder incentive may look great, but you need to understand what it is actually doing. Is it reducing your rate temporarily? Is it reducing the rate permanently? Is it covering closing costs? Is it tied to the builder's preferred lender? What is the price of the home compared to the resale market? And what happens after the buy down period ends? These are real questions. And when people only chase the lowest rate, they can miss the bigger picture. What is the rate? The better question is not just what is the rate. The better question is, what is the full cost of this loan? What is the payment and how much cash do I need? And what position am I in after closing? That is a much better way to think, because the rate is just one piece of the decision. It's not the whole decision. One of the biggest problems buyers face is payment shock. Payment shock is when your new housing payment is significantly higher than what you're used to paying. Maybe you were renting for $1,500 and now your projected mortgage is $2,600, let's say. Maybe you were living with family and now you're taking on a full housing payment for the first time. Maybe your rent was low because you've been in the same place for years. Maybe your approval technically works, but the new payment is a major jump. And that does not automatically mean you should not buy, but it does mean you need to be honest, because once you close, the payment is real. The lender is not making the payment, is not the one making the payment. The real estate agent is not the one making the payment, and your builder is not making the payment. You are. And if the payment feels uncomfortable before closing, it may even feel heavier after closing when the whole total cost of ownership hits. Maintenance, utilities, furniture, and life starts hitting. This is why I like buyers to reverse engineer the payment. Instead of starting with how much can I buy, start with what monthly payment would actually make me feel comfortable. Then work backwards. Based on that payment, we can look at price range, taxes, insurance, loan type, down payment, concessions, rate, and structure. That's a mouthful. And then that's the healthier way to shop, because you are not letting the approval amount lead the decision. You are letting your actual life lead the decision. Debt. Let's talk about it. This is one of the areas where buyers get frustrated because they have good income, but their approval is lower than expected. I see this all the time. I talk to clients all the time. And a lot of times, the reason is existing debt. And the biggest elephant in the room, car payments. They are a big one. Huge. Credit cards, student loans, personal loans, they all, tie into it, and they all affect your purchasing power, but the car payments are the big one. Buy now, pay later obligations, all of that can affect how much room you have for a mortgage payment. They eat away at your purchasing power because they eat away at your monthly payment. And I know, and sometimes people hear this and think, well, I make enough money. But mortgage qualification is not just income. It's income compared to other monthly obligations. That's why two people making the same income can have completely different approval outcomes. One person may qualify comfortably because they have a low monthly debt. Another person may struggle because a big portion of their income is already committed before the mortgage is even added. This is why I tell buyers, before you fall in love with houses, understand your debt picture. Do not go finance a car right before buying a house. Don't open new credit cards without talking to your lender. Do not assume a small monthly payment does not matter, because sometimes a few $100s in monthly debt can totally affect your pre-approval and can make a big difference in what you qualify for. Again, this does not mean that debt is automatically bad. It just means that debt affects the math. And if you understand the math early, you can make better decisions. The best loan program depends on the buyer. This is another thing nobody explains clearly enough, and it's that the best loan program depends on the buyer. FHA is not automatically bad. Conventional is not automatically better. VA is not just for military buyers in a generic sense. It can be an incredibly powerful tool when used correctly by eligible buyers. USDA can be powerful in eligible areas and situations. Down payment assistance can help some buyers, but may not be the best fit for everyone. The right loan program depends on the full file: credit score, debt to income ratio, cash to close, property type, occupancy, location, seller concessions, builder incentives, long-term plan, how long do you expect to stay in the home, whether you may refinance later, what your current savings look like. This is why I do not like when people ask online, which is better, FHA or conventional? The real answer is, for who? Based on what numbers? With what goal? On what property? And at what payment? With how much cash left over after closing? That is the advisor conversation, because the loan program is not just a label. It changes the payment, the cash needed, the mortgage insurance, the flexibility, the approval guidelines, and sometimes even how competitive your offer looks. So before you get attached to one loan type, compare the actual options, not the theory, the actual numbers. The worst time to learn the numbers is after you fall in love with the house. It's one of the worst things you can do as a buyer, is start shopping seriously before you understand the numbers. Because once you fall in love with the house, logic starts to get weaker. It happens all the time. You walk in, you love the kitchen, you love the big backyard, you picture the family there, you already see the furniture, you're already imagining the holidays, and now instead of asking, does this make sense, you start asking, how do I make this work? Those are two very different questions. And sometimes making it work is fine. Don't get me wrong, go big or go home. I get it, you're planning for the future, etc. But sometimes making it work means stretching too far. That is why the numbers need to come first. Not because the house does not matter. Of course the house matters. You have to like where you live. But the house needs to fit the financial decision, not the other way around. A home should support your life. It should not trap your life. So before you get emotionally attached, look at the payment, the cash to close, the reserves after closing, the loan type, the taxes, the insurance, the HOA, the commute, the maintenance, the long-term plan. That does not make the process less exciting. It makes it safer. It gives you confidence, because when you finally do find the right house, you're not guessing. You already know what makes sense. Here's what I'd look at before telling you to buy. If you were sitting across from me and asking me, Ivan, do you think I'm ready to buy? Here's what I would want to look at. First, your income. Not just what you make, but how stable it is, how it's documented, and whether there's any changes coming. Secondly, would be monthly debts. Car payments, credit cards, student loans, personal loans, child support, anything that affects your monthly picture. Third would be your target payment, not just max approval. I want to know that the payment actually feels comfortable for you. Fourth would be your cash to close. How much do you have available, and how much do you want to keep after closing? Fifth would be reserves, because buying a house and having nothing left is not always a good position to be in. Sixth would be timeline. Are you buying now, in 3 months, 6 months, a year? Because the strategy changes depending on the timeline. Seventh would be loan options. FHA, conventional, VA, USDA, down payment assistance, builder incentives, whatever applies to the current situation. Eighth, how long do you plan to stay? Because sometimes buying makes more sense when the time horizon makes sense. Ninth would be the property type. New construction, resale, condo, manufactured home, investment property, all of that changes the conversation. And 10th, your actual goal. Are you trying to lower your monthly cost, build equity? Are you trying to stop renting? Are you trying to move for a family, PCS, buy your first home? Are you starting to invest, create stability? Because the goal matters. The mortgage is not just paperwork, it's part of the strategy. And this is why I say, if you want help thinking through your specific situation, there's a link in the description. Not because you need to be pressured into buying, actually the opposite. The goal is clarity. Sometimes the answer is, yes, you're ready. Sometimes the answer is, you're close, but fix this first. And sometimes the answer is, let's wait and position you better. This is still a win if it helps you make a smarter decision. Buying later can be smart. Waiting blindly is not. So let's talk about waiting, because some people should wait. I want to be very clear about that. There are situations where buying right now may not be the best move. Maybe the payment is too uncomfortable. Maybe the cash reserves are too low. Maybe the job situation is uncertain. Maybe debt needs to be cleaned up. Maybe credit needs improvement. Maybe the buyer is not sure if they will stay in the area long enough. That's a whole different video in its own self. Maybe they're just not ready, and that's okay. Buying a house is a big life event. I never forget that. There is nothing wrong with waiting if waiting is part of the plan. But waiting blindly is different. If you're just waiting because you're scared, because you don't know what number would make sense, what payment you need, what credit score you need, how much cash you need, or what timeline you're working toward, then you're not really waiting strategically. You're just delaying. A better approach is to get clarity. Maybe you're 6 months away. Maybe you're 12 months away. Maybe you're closer than you think. Maybe you're not ready as you thought. Either way, knowing is better than guessing, because the time is going to pass anyway. And the question is, are you using that time to get positioned, or are you just hoping things somehow get easier? That is a big difference. Do not let fear or FOMO make the decision. One of the hardest parts about buying a house is that there is pressure from both sides. One side, fear says, don't buy. What if rates drop? What if prices fall? What if something goes wrong? On the other side, FOMO says, buy now, hurry, you're missing out, you'll never get another chance. Both can lead to bad decisions. Fear can keep you stuck forever, and FOMO can push you into a payment that does not fit. The goal is to not be afraid. The goal is to not be rushed. The goal is to be clear. Clear on your numbers, clear on your payment, clear on your cash, clear on the loan structure, clear on the trade-offs, clear on what you're trying to accomplish. That is why I believe buyers need education before pressure, because when you understand the decision, you do not need to be manipulated. You can move in when it makes sense. You can wait when it makes sense. You can compare options without panic, and the entire point of this channel, that's it. Not to tell everybody to buy, not to tell everybody to wait, but to help you understand the real numbers and the real trade-offs so you can make a better decision. The question is not, can I buy? It's, should I? So let's bring it all together. Getting approved matters. You need a pre-approval if you are serious about buying, but the approval, as I've stated multiple times before, is not the finish line. It is the starting point. The approval tells you what may be possible, but then you need to decide what is actually wise. The question is not just, can I buy? The question is, should I buy at this payment? Should I use this loan program? Should I put this much down? Should I keep more cash? Should I wait? Should I pay off debt first? Should I buy new construction? Should I use seller concessions? Should I refinance later if the opportunity makes sense? Should I be shopping at the top of my approval? Those are better questions, because the house is not just an asset, it's also a monthly obligation, and it affects your stress, your flexibility, your family, your ability to save, your ability to invest, your ability to live. And that's why the real goal is not just home ownership. The real goal is home ownership that fits your life. So if you're thinking about buying a house in 2026, here's the biggest thing that I want you to take away from this video. Do not treat the pre-approval or the approval amount like your budget. Treat it like information that it is. Then build a strategy around your actual life, starting with the payment. Then look at cash to close, look at the debt, look at the taxes, look at the insurance, look at the loan options, look at the money left after closing, look at your timeline, look at your goals, and then decide. This is how you make a better home buying decision, not by guessing, not by chasing that max approval, not by letting fear stop you, not by letting pressure rush you, but by understanding the numbers before you move. So if you want me to run your numbers based on your situation, there's a link in the description. As always, no pressure, just clarity. And if this video helped you, subscribe to the channel, because I'm going to be breaking down real world side of home buying, mortgages, affordability, and the decisions buyers need to understand before they make a move. And as always, life is good. Always make it count.